Welcome back to Squawk Box. Rick Santelli here, live from the CME HQ with breaking economic news. Our January read on retail sales. Headline number up much stronger than the 2% expected, up 3.8%. Remember, last month we were down 1.9%, so we're reversing a bit. X-autos, and remember, we're looking for autos to be pretty powerful. So X-autos at 3.3%, still more than triple the 1% expected, really is a surprise. And if we consider X-autos and gas still holding up, equal to the headline at up 3.8%. Now, the one fly in the ointment, this isn't adjusted for inflation. Higher inflation means higher retail sales, not necessarily more aggressive purchases or more purchases. And if we look at the control group, it's a whopping up 4.8%, which gets imputed into higher up the food chain economic data. Now let's look at import and export prices. Also for the month of January, month over month up 2%. That's almost double the expectations. And if you look at January ex-petroleum import prices, you can see that import prices on the energy side boosted those a bit because it drops down to 1.4. The year-over-year number, 10.8. And like all year-over-year numbers, these are powerful. We see in the rearview mirror that there's building pressures. And that 10.8%, well, it is far from the highest level. We're at 11.7% at the end of last year. If we look at export prices now month over month, up 2.9%, almost exactly double the expectations. And the year-over-year number there, up 15.1%. The record high watermark was in October, up 18.3%. So just like in China, year-over-year inflation, at least represented by these prices, has come down, but come down from what was hugely lofty levels pre-COVID and supply chain issues. And once again, I want to stress, retail sales was very good, but not adjusted for inflation. It doesn't include the service side except for restaurants, so you have to kind of put that into your equation when you look at the better-than-expected data. Joe, back to you.
Right. Okay, Rick, thanks. Steve Leisman joins us now with those caveats in mind. Hey, Steve.
Hey, Joe, yeah, I mean, it's still a good report. And I think Rick hit the nail on the head with this idea. We were expecting a big change in autos. And autos are going to help retail sales for several months. Even if the economy is slowing, we're going to have a bounce back in autos, which are running way below their normal levels. So you take out autos and you do 3.3. By the way, worth reporting, I believe there was a revision to the prior month, which was down 1.9 originally. Now it's down 2.5. So that's going to bring a little bit down the fourth quarter GDP number that we've been working with. And it will flatter, as Rick said, the control group moving in at that huge number. I think he said it was up 4%. So that's a big number. What I'm looking for, Joe, in all of these numbers and some of the retail earnings reports that we've had that we're going to get today from Courtney, she'll be talking about those, is this word resistance, consumer resistance. Are these prices reaching a level where people are balking at buying them? And we're just not seeing it. And one way we can, on the fly, adjust this data for inflation is total retail food services are up 13% year over year. We know that inflation is up 7%. So we can do the math right here live on national television and tell you that we're still up 6% year over year. Now, that's come down a little bit, that year over year rate, which I reported this morning at 16%. But bottom line is consumers to this point still seem to have the ability to go out, pay the inflation tax that's on there, and spend some more. The part of the process of bringing down inflation is going to be this consumer resistance. We haven't seen it yet. You guys, Joe, you're talking out to these retail executives and stuff like that, and you just have to let me know if you're hearing anybody say, hey, Steve, we raised prices, and people stop buying. But it's not happened yet.